Seth, we're expecting some, and Julia, we're expecting some really insightful things here. And we need it, Seth, because it's obvious they're probably going 50. Beyond that, what do we know about what they're going to say and what they're facing?
That's a great point, Joe. Yeah, they telegraphed the 50 extraordinarily well. They've also telegraphed very well that they're planning on making the decision on unwinding their balance sheet at this meeting and having that runoff start at the June meeting. So I think a lot of the details about the tightening of policy over the next couple of months are clear. I think where the surprises come in, or where we have to pay a lot of attention, is does Chair Powell in the press conference, does he lean in or does he lean out from the prospect of a 75 basis point hike at subsequent meetings? And does he lean in or does he lean out from the prospect of mortgage-backed security sales? But I think the policy actions for today have been so well telegraphed that there shouldn't be that much surprise.
Julia, I've had both viewpoints expressed, and one is that the Fed's going to overshoot because of what, it's not transitory, but maybe it's one-off factors causing some of this inflation. If they go, let's say that, what Seth just said, let's say they do 50 and then they imply they might go 75. Could they overshoot? Is that necessary?
So when you're saying overshoot, you're saying take the funds rate above what most people consider to be a neutral funds rate. And certainly that's possible.
Too fast, too high. Yeah.
Meaning too fast, will they cause a recession? So there's two different concepts. One, are they going to go beyond neutral on the Fed funds rate? That is, their estimate of neutral is 2.5%. Will they go above that? Maybe. The market's pricing that they'll have to go a little bit beyond that because not only is inflation high, but the underlying demand in the economy is strong. The reasons they might not have to go that far or that fast is that they are doing balance sheet tightening at the same time. And some of that's priced in, but not all of that. We know there's some flow effect to this. So they're going to have both tools of tightening acting at the same time, which will tighten financial conditions and cool off the economy. And also the other thing that is acting to slow the economy down is the removal of fiscal support. And we see that was in full evidence in the Q1 GDP report. And some of the things you were citing in earnings reports, are consumers becoming more price sensitive as that fiscal cash fades away? That's certainly a dimension we're watching for in the inflation numbers. So there's a lot of things acting to slow the economy down, not just the Fed, fiscal policy, the shock of headline inflation from the war in Ukraine, and the Fed's using two tools at the same time. So will they go too far too fast? That certainly is a risk. On the other hand, we've got an incredibly strong, virtuous cycle between hiring and consumer spending right now. That's kind of the essential ingredient to any expansion. So that couldn't look any better than it does right now. Consumer balance sheets are strong. Delinquencies on loans are at all-time lows across the board. So, I mean, from a fundamental perspective, we've got a lot of underlying momentum to weather this tightening. And I think your question may be one reason that the Fed stays at the 50 basis point per meeting pace rather than accelerating.